With us, we have Mr. Arun. Hello, Mr. Arun.
Hi, good afternoon.
We have seen the divisions between the Wall Street banks about the interest rate hikes in 2023. They are all agreeing on the hikes, but they don't know when it will slow down. When do you think the Federal Reserve will start slowing down the tight policies?
So, according to the current indications, most likely by the December meeting itself, the US Federal Reserve might begin to slow down the pace of rate hikes. Markets, in general, what we expect is a 50 basis point rate hike in the December meeting. It might be followed by a 25 basis point rate hike and maybe another 25 basis point rate hike after that. So in aggregate, we expect the Fed terminal rate to be near 5% in the next 2 quarters. So that could be the top of the current interest rate cycle, and the Federal Reserve most likely might stay at that level for some period of time till it sees indications that the economy is slowing down, till it gets a confirmation that the inflation is coming down. So the peak might be 5%, but it might remain at that level for some period of time. That's what we foresee. So, yes.
Mr. Arun, speaking about all those divisions between the markets, they agree on the labor market, which is strong in the US. So shall we expect any slowing down in the labor market soon, which might lead to better decisions?
There are some preliminary indications that the labor market is, there's more of anecdotal evidence rather than real evidence. So there are a bunch of layoffs that are happening in the tech sector. Facebook is laying off employees, Twitter is laying off some employees. So in the tech sector, the layoffs have begun, but that has not translated into any weakness in the broader US labor market. I think it is inevitable that some weakness will be kicking into the US job market also. Already, various regions of the world, whether it is China, whether it is Europe or major economies like India, they're all showing signs of a weakness or softness in demand. So at some point of time, the US economy, the weakness that is happening, the slowdown that is happening in the economy will be translating to a reduction in the overall employment numbers. Already we are seeing the jolt, job opening and a labor turnover, that particular ratio actually falling from its highs. So there is a possibility that in the coming months we could be seeing the weakness in the, again, just to add, housing sector, which is actually one of the largest contributors to GDP inside the United States, it's already seeing signs of topping out. So there are some signs that the high interest rates that the Fed has imposed upon the economy is impacting the small scale firms as well as the households. So it will be impacting the labor market for sure. And once the labor market starts to weaken, that could be the time when the Fed pivots its policy from hawkish to maybe a less hawkish or maybe even a dovish stance.
Yes, and this is one of the elements that is pushing the policymakers to be divided in their opinions. We have heard James Pollard statements saying that the interest rates might reach to between 5 to 7%, but while the Atlanta Federal Reserve official said that he prefers to be less tight. Are we seeing real divisions between the central bank's presidents, and will this change the expectations that you mentioned?
I think the Bullard number that is stated that the rates can go up to as high as 7%. I think it is a bit overextended. I mean, it's over the top. I think that's what I feel. I mean, rates at that particular level will be devastating for the economy. It is highly unlikely that the Federal Reserve will be doing anything like that. I mean, there is again, it's tough to give a prediction on the rates, as all of us know. I mean, we have most of us have got the pace of Fed interest rate hikes trajectory wrong. They 1 year back, none of us expected the rates to be increased this much. But again, having said that, rates of 7%, terminal rate of 7% seems far-fetched, highly unlikely. 5% seems to be the ideal top in the interest rate cycle, because already we are seeing signs of a slowdown in the economy. We are seeing signs of a slowdown in the major global economies. So 5% is the number that I think where the Fed will be stopping the interest rate hikes.
Okay, what about the markets and the error margin or the error benchmark? How can you explain the lockdowns in the Wall Street, in the green area, disregarding all the statements from the Federal Reserve and closing sessions that ignore the tightening policies going on? What do you think about that?
I agree that the market SPX 500 in particular has staged a remarkable comeback from its lows. I mean, from 3,400, 500, that zone, the index has rose to as high as near the 4,100 levels, which is incredible. But let us not forget about the price action that is happening inside the index. They have been very sharp up moves. If I talk about the Nasdaq index, I think there were a few days where the sessions where the Nasdaq actually rose by about 5% in one single day or one single session. So this kind of price action doesn't happen in a bull market or if the market is actually strong. Sharp up moves are characteristics of bear market rallies. I mean, people who have experienced the 2008 bear market or even partly the 2020 rated downward move, they have seen a lot of sharp up moves in between when the markets were falling. So most of this market up moves, they are generally short covering by the bears.
Thank you very much, Mr. Arun. They are interrupting you because time is up. Thank you very much.
Sure, thanks.